Welcome, everyone. Thank you for joining us today. I'm 𝗖𝗽𝗶𝘁 Biniaz, joined by 𝗖𝗽𝗶 Benesocky. Welcome, Ava.
Thank you very much, August. And thank you, everybody, for joining us today. Today, it's just a pleasure to have Buck Joffrey join us. Now, Buck is the guru of building wealth with passive income. Buck outlines the principles that have allowed him and numerous other professionals to transform their own lives and escape the modern day paradigm of trading time for money. We're just going to mute the one person here.
I think maybe it might be, oh yeah, so we're just going to mute our friend over here. Great. So wonderful. Welcome, Buck.
Welcome, Buck.
Hey, yeah, thanks for having me.
Awesome.
So why don't we start off by, Buck, we would love to start off by, why don't you tell everybody about your background? Because they see a doctor, a wealth coach. So please tell us about yourself and how you got involved in the field that you're in now.
Yeah, I started out like a lot of physicians, where I was just, as an A student, prep school, and just kind of was good at school. And when you're good at school and you go to the the fancy schools, and usually most of the time you're left with a decision on what you're going to do for a living, and you only think about a couple things. You think about being a lawyer, being a doctor, things like that. And for me, I was a little bit later decision for me, but I was started out as a history major and finished that, and ended up doing a biochemistry major after that. And then at that point, what do you do with the biochemistry majors? I just went to med school. And medicine was good. I enjoyed it, and I became a surgeon. I liked operating, but I think for me, I just kind of have a little bit of an ADD. I think I'm probably more wired as an entrepreneur than I am as a physician. So after a few years of having my own practice and that sort of thing, I just decided I got more interested in trying to figure out other things to do. Money in medicine is good. It's fine. But I was also trying to figure out how to make more. And I read a book by Robert Kiyosaki called The Cash Flow Quadrant right around the time when I finished residency, that really kind of inspired me to think about the world of entrepreneurship. I think that sometimes when you're good at school, when you're good at, you get the grades, and, you just get this Pavlovian, type response to positive feedback, and you just keep going through the motions and looking for more school and more success, as that's defined through school. And I think that was on that path. And I think that's probably something that a lot of physicians resonate with. But the book, Cash Flow Quadrant, kind of took me out of the paradigm, Robert's book did, and made me think about, hey, this idea of creating your own wealth and being in this different type of, path was very appealing. Of course, Robert's famous for really advocating for real estate. And so even though I actually came from a real estate family, I for the most part, had rejected my own father's ideas as, just being dad's ideas. But at this point, I kind of came back to it, started investing in real estate, buying apartment buildings myself, and had some success with that. Timing was also very good for me. So, I bought some buildings in Chicago when I was living there, and turned around a few years and sold them for, 500% profits. And so I had some good luck there. And then ultimately realized that I wasn't so interested in necessarily in being a landlord. And I had some successes in business after med school with my practice and stuff. So started viewing real estate and investing more at a higher level as a business rather than as a landlord. And I think that's ultimately how, what I'm doing now, which is essentially I've created a private equity company with investors largely made up of physicians, and it's not all physicians, but probably about 70% physicians and dentists and, other healthcare professionals. And then there's a lot, I've got others in there too, but they all tend to share that sort of highly educated, professional background. Some of them are business people who've had big liquidity events, but for the most part, most of them fall into that. So, yeah, that's basically the story. Of course, I'm a podcaster. The podcast itself is generated out of my own interest in alternative investing while I was still practicing. And it just caught on. I think a lot of people who had this similar background found my message valuable. And so I have a podcast called Wealth Formula. And, that's really sort of the basis of, my investor group. So that's kind of my story. I don't know if I.
No, that's perfect. That
Fantastic.
was great. I appreciate
Thank you
it.
for sharing that.
And that kind of it's a great kind of segue into my next question here is that you followed the kind of standard roadmap of go to school, and get a job. And not only that, you eventually got to the pinnacle of success in your field as being a surgeon, having working in that field. But there was a aha moment where you shifted, saying, "Hey, listen, I've done perfect here, but I'm more of an entrepreneur at heart." And you begin to, how was that transition? Because that's transition and that understanding in itself is, I would say, one of the most difficult things people, kind of the hurdle people have to go through in life to make that decision to leave, if it's their job, if it's their career. And with you is, like I said a moment ago, you were at the pinnacle of success in that goal that you probably took years to achieve, and then to make that switch. Kind of talk to us about that switch.
Well, it's it's a, listen, I think that there's a little bit of a trap that's set up for successful people. Robert, and I'll quote Robert Kiyosaki again, because, a lot of my initial paradigm switches were because of Robert's books. And I've told him that as such, but he talks about how A students work for B students, or no, I'm sorry. A students work for C students and B students work for the government. So A students work for C students because the C students took a lot more chances. And why did they take a lot more chances? Well, because they were used to failure more than the A students, right? I mean, listen, what is entrepreneurship all about? Entrepreneurship is all about taking risks, and no risk it, no biscuit, right? And it's all about that kind of mentality. If you go through life and you constantly, again, get that Pavlovian response of positive feedback from teachers, from, the A's on your report card and all that, you're very unlikely to take a risk, because it's not a comfortable thing and you're used to success. So I think part of the challenge for successful people, and I'm using success in terms of academics, is that you have to actually find a reason, and you have to find the guts to actually move. Now, unfortunately, I think that there's a lot of unhappy physicians. There's a lot of unhappy professionals out there that will just keep doing what they're doing because they've spent so much time doing it. You're right. I did spend a lot of time. I spent 4 years, and obviously in college, 4 years in med school. I did 2 years of neurosurgery, did 5 years of head and neck surgery, a year of plastic surgery, and that was my training. So that's a lot of years. So there's two things. There's one, you have success and people, you get positive feedback. The other one is you're like, well, gosh, I'm 35 years old now and I'm just starting my career. 5 years into it, you're not happy. Well, at that point, you're thinking, well, I did put in like 15 years into this. I can't move now. the problem is that the problem is that that's a terrible way to live, right? So so I think there's that. I think there's an element of people just continuing to do what they do because they're kind of into it, and that's, you know, that's they're 15, 20 years into it. And there's also an element of golden handcuffs, you know, where you're making $500,000 a year, something like that, and your comfortable life in the suburbs. I mean, it's hard to just change. There's not a lot of things that most physicians are gonna do that is gonna make them as much money as, you know, what they're currently doing, right? So that makes it hard. Now, so what's the alternative to that? Well, the reality is, most people shouldn't do what I did. You know, they shouldn't, because I think you have to have large coronary arteries. You have to be willing to give it all up, and and there's a significant risk to it. And not everybody's a good entrepreneur, and so you may fail miserably. So what other options do you have in that situation? Well, you know, going back to the idea of the cash flow quadrant, which was Robert Kiyosaki's book, you know, you have the quadrant talks about the different types of income, the way people make money. I would recommend reading it to anybody out there. It's a good sort of paradigm shift type of book. But, you know, you have the W-2, the worker, up in the upper left corner. Below that, you have the self-employed individual who's, you know, maybe not taking advantage of all the business elements, but essentially owns a job. You don't own a business, but you own a job. Like, you know, most physicians in private practice, they own a job, right? I mean, they don't own a business. And then if you go up into the other side, which is the better part of the quadrant, in the upper right corner, you have the business owner, larger business owner. And then in the lower right, you have the investor. So part of the strategy that I've talked about with my investors, with my group is, listen, it may be the case that we are all really good at generating income from our day jobs in our our W-2 jobs, our self-employed jobs, or practice, whatever. Don't think that the only way out is leaving all of that, because your best way of making money may still be, and probably is, what you do. But recognize that if you want to be somewhere else, let's start focusing in on this investment quadrant. And that's really kind of what my message is all about, is building that investment quadrant.
Great. No, I
Incredible.
appreciate that.
So why don't you mentioned Robert Kiyosaki a couple times, and he obviously is the godfather of entrepreneurial mindset and wealth building. Now, I know you're good friends with Robert. I've watched the interview that you had with him on your show. So why don't you tell us more about the man, the inner workings of his mind, and possibly talk to us about his brilliance, and if you got the chance to pick his brain.
Well, I don't know that we're good friends. I've talked to him a few times, and luckily,
the pictures and the videos online says otherwise.
Yeah.
Well, I've talked to him I certainly have spent some time with him, and I've interviewed him a few times, and I have gotten to pick his brain. And we were on a cruise, actually, like an investment cruise, and it just so happened, it was a really weird thing. I ended up at breakfast with him almost every day, because we seem to be skipping the same morning class, and then we'll end up sitting somewhere. So I did spend a lot of time with him. You know, I think Robert is he's an interesting guy. I think he's very smart. I think there's, at this point, I think he's obviously got a lot of political things and all that I don't necessarily agree with, but the books that he wrote, I think some of the things that were interesting that he told me, that first of all, I think you might find that Rich Dad Poor Dad obviously is the most famous book of all time that he wrote, and it's the #1 selling finance book of in history. The funny thing is that Robert told me that he wrote that book not with the intention necessarily of it being like this, best-selling book, but he had this game that him and his wife that he talks about in Cash Flow Quadrant. They were trying to do this game called uh, what is it called? What's the famous game? I can't remember it. Anyway, they have a board game.
Okay.
It's like the Rich Dad something.
Monopoly, is it, or something?
It's not Monopoly. They had their own game. I can't remember, but it's all the Kiyosaki people play it.
Okay.
Okay.
It's a Cash Flow. I think it's just playing. It's called Cash Flow or something like that.
Okay.
Anyway, they had this game, and Robert wrote this book as a promotional piece to try to promote that game, the Cash Flow board game. So it was not intended to be the #1 best-selling book of all time in finance. It was a book that was supposed to promote this cash flow board game. So I thought that was interesting. I also think that he is the other thing is that with regard to his books, I think they become increasing in sophistication, right? They become increasing in sophistication. If you go to the Rich Dad Poor Dad book is really written for the masses, and then Cash Flow Quadrant is really written for people like me and other physicians and professionals to open their eyes to different kinds of income and why they're trapped where they are. And then the books that came after that sort of they're more and more, the level of sophistication goes up over time. So I think that was on purpose. I think the other thing I think it's important and useful to know about Robert Kiyosaki is that he believes in real estate, and obviously there's like an entire generation or two now of people who have been influenced so much in the idea of real estate, and they came to him from Robert Kiyosaki. But remember, and Robert will tell you himself, he's like, I'm not a real estate guy. Like, people think of Robert and they think he's like walking around, these apartment buildings and looking at them and all that. No, he is a guy who's a business guy. He's an entrepreneur who invests passively in real estate. Most of the investments that he's made in real estate are with Kenny McElroy, our friend Kenny McElroy, who is, rich dad advisor to real estate, and who's a syndicator based out of Arizona. And Kenny's really nice. He's a great guy. I know Ken more than I know Robert. So he's built a lot of wealth through Ken and partnering with Ken through limited partnerships and that kind of thing. So understanding that like investing in real estate isn't just about being a landlord. It's about the value of finding a good, finding a few different partners who do really good work and letting them make you money. So that's the other thing. So, I mean, like I said, I don't know him very well. I've talked to him a few times and had a chance to really pick his brain, but those are a few highlights.
Great.
Thank you for sharing that, Buck. Now the exciting part, I wanna just quickly talk to Buck.
Everything's exciting.
I
when we
know
talk
everything's
to Buck.
exciting.
We were just waiting for a while to get him on our show, but go ahead.
Absolutely. So I want to talk to you about the wealth formula that you created, Wealth 2.0. When August and I first heard about this, we thought it was just kind of a fun topic, but there's an actual wealth formula which calculates the wealth building process.
Like a mathematical formula
Yeah.
you've incorporated into this concept
We'd
of.
love to share.
So if you can,
Well, I think it's useful because so many of my my investors are kind of nerdy, equation people, right? But so the idea came to me that I was just playing around with this idea, and in Newtonian physics, momentum is mass times volume, or mass times velocity. Sorry,
Right.
and mass times velocity. And there was a little post-COVID kicking in there. And so for me, I was kind of playing and riffing off of that because I was like, momentum is mass times velocity. Well, momentum in creating wealth, well, that to me is similar in that what are the variables? So what are the variables in creating wealth? So um, looking back at, successful investments and understanding the way that, wealthy people generally tend to look at investing as opposed to, middle class, it occurred to me that there's a few variables that are really important. One is in actually investing money, right? So that's important. And so I used mass in the momentum equation. And so mass is really just about how much money you are investing, how much money you invest, because regardless of the returns, if you don't invest anything, you're not going to make any money back. Now, that is obvious until it's not, because if you think about, well, why do the rich get richer? Why do wealthy people get um, more wealthy? It's because a larger percentage of the money that they have goes towards investing, right? I mean, if you're taking 10, 20, 10% of your paycheck towards investing and growing that wealth, you're going to end up with probably a lot less money than if you could take 80% of the money that you make in a given year and invest it. So simple concept, but it's profoundly important. So, we don't really, philosophically, I don't really advocate for people, living way under their means and stuff. Life's too short for that. But I do like the idea of having people think about living more and more off of their investments rather than off of their paycheck. And so, invest more, especially early in life, a higher percentage is if you can. I mean, even now, I mean, personally, I still invest probably 70 to 80% of every dollar I make. And so, I certainly drink the Kool-Aid on that, right? That's really important to me. So that's mass. Velocity is the velocity part for me in the momentum equation. If you transfer that over to the wealth equation, is about how quickly you get your money back out of an investment. Now, that is related to what we consider a return on investment or a yield or whatever, right? But let's think about really what that is. So if you're getting a 7 or 8%, or let's use 10% return on investment. And if you just sat around for 10 years, well, then you just get your money back in 10 years. Well, that 10% sounds good until you realize you really haven't made any money on your money for 10 years. And it doesn't sound so good anymore. So one of the ideas is, okay, how can you quickly recycle money? Because if we only have a finite amount of money, if we can only take 10, 15% of our paycheck and put it into investments, how do you, rather than try to make more money and invest more, how can we invest more? Well, we can recycle the same money over and over and over again and have it work in multiple places at the same time. So there's lots of ways you can do that. Uh, and you see, in real estate, obviously we have the concept of, refinance, and being able to pull out money and reinvesting that money into another deal. You have the concept of simply, essentially flipping, although, flipping is better if it's done with a value add perspective rather than just, just, just anticipating markets go up. So in real estate, you have that, but you have it in other areas too. I don't do this much anymore, but I used to play around with the junior mining sector, a very speculative thing. And in the private placement world, you a lot of times you could buy, shares, and then you'd also get these, essentially you get these options along with it. And so one of the plays there was you just you would sell your shares as soon as you could make your money back and then hold on to these free options you got with it. Again, it's like recycling money into multiple places. We use this in various types of insurance products as well. There's lots of different ways that you can do it, but at the end of the day, the big picture is that the quicker you can get your money to move from one deal to the next deal to the next deal, the more money you're going to make, right? It's just it's simple math that becomes, compounding, and most people don't do that, right? I mean, the way we're taught to invest safely and conservatively and all that is by putting our money into, at least you're in the US, putting your money into mutual funds and the S&P 500 and growing hopefully you're growing at an average of 7% per year. Maybe you are, maybe you're not, who knows? But it's a very passive type of activity that hopefully it works. But for at least for my listeners, the idea of getting really getting involved and pushing those numbers is of value. So those are the two numbers. Now the two variables, the mass and volume, but the additional one is perhaps the most important because it's not in the momentum equation, but it's in the wealth equation, and that is leverage. Leverage is obviously anything is a lever or leverage if it can amplify what it is that you're doing. It's a tool to make what you're doing more powerful and to be more, to get more use out of it, to get more, to make it more efficient. And leverage is that. A leverage, of course, what I'm talking about is really debt, right? It's good debt, as Robert Kiyosaki would call it, good debt. It's debt that is that's helping you create wealth. It's not debt on a credit card to buy a TV or something. And that's where I think philosophically so much of what I have to say differs from a lot of the wealth gurus, at least in the U.S., the Dave Ramsey's and all this of the world, is debt is good. Debt is, it is, and I'll take it another step. It is virtually impossible for, somebody who's not a professional athlete, an entertainer, somebody who wins the lottery, unless you're one of those people, it's virtually impossible for somebody to become extremely wealthy without debt, without leverage. And real estate, obviously, so much of it is predicated on the use of debt. And that's why, we're used to getting returns that are 20 plus annualized returns and IRRs like that, whereas the rest of the world isn't. It's because of debt. Leverage is critical to amplify mass and velocity. The other thing that's really key about leverage and debt right now, well, always, but especially right now, is if you believe there is that we're headed towards increasing levels of inflation, which is hard to imagine that we're not, right? We're printing an awful lot of money. What happens to debt with inflation? Well, let's think about that in terms of our own houses or maybe our parents' houses. They bought their house like 20 years ago and they put down a certain money and then they had a certain amount of debt. And now they still have that house and that's 15 years later. Guess what? The debt that they had is now worth less today than it was when they borrowed it. So inflation, which we believe is, it's gonna, we have to have inflation, right? And at least in the, and I'll get back to that in a second. But when you have inflation, it erodes debt. So that's the way as an individual, you can print your own money, right? So think about that from the government standpoint. Why in the US is inflation critically important. In fact, it's one of the Federal Reserve's mandates is to maintain inflation at least 2 to 3%. And why is that? Because there's a debt burden on the government. They have to pay their own debts in the form of sovereign debt. And there's only really a couple ways you can do that. You can have GDP growth that's so substantial that tax money easily covers it, or you can artificially deflate how much debt you have, watering it down. And that's what the government does, because inflation essentially makes that debt worth less. So we can take a lesson out of the book of what the government's doing, and understand for ourselves that if we use debt, we won't have to pay as much later, and that is effectively kind of like printing your own money, right? So anyway, those are the three variables to the wealth formula.
That's great.
Incredible.
And do you, I watched a few of your interviews, and I've seen you actually had a graph and a chart, a presentation. If you, by any chance, have a PDF of that, it'd be great. We can share it to the attendees of this webinar. If you have it, if not, that's totally fine. And I guess the next kind of subject I want to speak with you about, rather than it being a question, is this. Obviously, our webinar today is about, we were focused on doctors. I think the title wasn't perfect, because this formula can really work for anyone who's looking to build wealth, anyone who is a professional who's also looking to invest. And I could kind of compare it to delegating the task of being the active investor and reaping most of the benefits. That's what this kind of what we do, is a concept of real estate syndication does. Sure. And doctors are great at allocating tasks. I mean, at times as we're discussing items, even with Ava, I'm like, hey, listen, I want to set everything up for you. So when you show up, you are like a surgeon who shows up to the surgery room. Yeah. Nurses is there, then anesthesiologist is there. Everybody who's involved in the process is there. Your tools are there. So this concept of real estate investing can also be delegated to groups to do that part, for the investor, for the passive investor. And that's kind of the question or topic I want to talk to you about. Just pulling up my notes here. So, and I want to transition it into doctors here in Canada. So, believe it or not, the provincial governments, like provinces, are equivalent of the states in the US. So the provincial governments here actually publish a report on what do doctors get paid here in BC and across other provinces. So you can actually see what doctors make. And doctors in particular seem to be a profession where they're very focused on what they do, because in most cases, people's lives are on the line. So they're very focused on what they do. And at times they don't get to focus on wealth building or investments, and they allocate that task out. And I kind of want to discuss that with you. And maybe I can share my screen here quickly so everybody can see what I'm talking about, as far as the government literally having, let's see here, like every doctors, and I've kind of gone over this, and ophthalmologists seem to be the people who make the most money. And as far as anytime you see these high numbers of 3 million, ends up being an ophthalmologist. But
I think it was 4.2 billion.
It's almost $5 billion is what's being paid to doctors, and that's not part of their salary. That's not part of the contracts they have. That's just what the province is paying them, $5 billion, almost $5 billion a year. Good point there, Ava. But how do we get you, Buck, to be in front of the doctors all across Canada, that they can see that there is a way to allocate the investment, or being a passive investor? Kind of talk to us about that concept. I mean, it's not really a question; it's more of a discussion. But
yeah. Well, I think what you're getting at is how do you get the information out to doctors that maybe they should invest in stuff outside of their the stock market, that kind of thing. And if that's the question, I'll tell you that doctors are a tough crowd They are a tough, tough crowd because, and again, I don't know about, it, I assume it's the same in Canada, but listen, doctors are known as people. They first of all um, they think they're smart at everything, so it's difficult to convince a doctor that they should be thinking a certain way if they already have their mind set on something. So I don't even honestly I don't solicit doctors at all. They find me if the message resonates. Um, the other problem is that they're used to getting screwed over, um, especially in the financial services space. Um, every when you look at financial advisors and attorneys and all that, I mean they look at doctors as chum, right? And so doctors are used to that. They know that that there's people out there who are just looking at them as a paycheck, so I think there's a level of distrust there and that kind of thing. And I would just tell you that from a discussion standpoint, I mean, again, I've never solicited for doctors, right? I mean, I have probably about 2,000 investors in my in my group, and probably about 1,500 of them are doctors. But I've never actively looked for anybody. I think the bottom line is it's a positioning issue, right? Like, I mean, you educate people, you let them know. If you can get in front of people and show them what you've done or what you know what you have to offer, that's part of it. But you also have to get people's trust. And how do you do that? Well, I think for me, the reason I think part of why, quite frankly, but why a number of people at least started with me was because I'm a fellow physician, and that certainly helps, right? Um, and then it becomes an issue of, well, then how do you perform? And then then it's really in your 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 ball game is becomes yours, and it's more in your control at that point. But um yeah, it's a tough question, August. I don't know the answer to it. I don't know how you get across to people because I don't think, and I could be wrong, but I don't think it's going to be particularly helpful to put up a stand at the medical convention and stuff. People walk right by you and they're just another person who's trying to get
I
my
was
money.
gonna rent a booth, but come on,
Yeah.
I was
Yeah. Renting booths and stuff. I've never done any of that. But again, I don't know the answer to that. I think the only way, I think right now, because I have, as many investors in my group as I do. I mean, certainly there's an element of, we're getting to the point where it's sort of a critical mass where, a lot of people telling other people and that kind of thing. And I think that that's the way generally that physicians work. I mean, the funny thing is with physicians is like, I'm absolutely, it's really incredible to me that there's like, tax firms or insurance firms or whatever that have somehow, a couple generations ago, somebody did something right and they just earned the trust of physicians. And now it's like these practices are just built on multiple generations of physicians. Most physicians coming out of school, I mean, the way we find, financial advisors, the way we find insurance people or any kind of broker or whatever is by asking other colleagues, who are you using? Who do I go to? That's how you do it, you know? And so it's an uphill battle. And so understand that real estate and alternative investing in general is in and of itself, it's a real hurdle. And you're dealing with that same problem as I told you before. If you have people who have succeeded with mainstream ideas and mainstream schooling, how are you going to convince them that they shouldn't invest like the mainstream? That's tough.
It is tough. I have lots of calls with doctors actually.
Yeah, Ava
and
has a lot
it's-
of call with doctors, and this whole concept of real estate, alternative investments in particular, being able to passively invest in multifamily and reap most of the benefits. Kind of talk to us about that. Why is multifamily or commercial institutional size type of investment is on top of your list or recommendations to your group, and what got you kind of interested in that? You spoke about your family was involved in real estate, but what is it about this kind of asset class that interests you?
Well, I like multifamily best in part because I understand it. And like you said, like, you know, I grew up with multifamily. My dad still does it. And he's did it the old fashioned way where, you know, it was apartment buildings and things like that. And he's always been sort of hands-on landlord guy. That's why I hated it. I didn't want any part of it growing up because her phone was ringing off the hook, and tenants, toilets, termites. And it was not something I want to do. However, if you look at multifamily, it is, you know, people need it, right? You have to live somewhere at the end of the day. And if you think about, like, the hierarchy of needs, right? Starts with food and water and then a shelter. So fundamentally, I think for me, it's always been like, I get it. I understand it. I've been around it, and people need it. And I think we've seen that, at least in the US across my group's portfolio. We've done very well throughout COVID. And a lot of it really just has to do with, what people end up, prioritizing on their list of things to pay. So for me, it's kind of what I grew up with, and what I'm comfortable with makes sense. And it's basically, been lucrative for my family from when I grew up to, now. So that's why. I mean, now that's not to say there's not money to be made in these other areas. Um, in my group, we're also involved. We're also involved a little bit in the self-storage space, which I get and I understand it, and has shown, significant, value even in recessionary times. So it's not like there's only one way to skin a cat, but I also don't like to spread myself too thin. I like to understand what it is that I'm doing. It's hard to be, you don't want to end up being sort of the, master of none. You really want to be able to make sure that you offer your, your clients or your investors and our, the clients of our, our private equity, um, your expertise. And for me, that's what it is right now. And unless somebody can really show me or teach me or tell me otherwise, I think multifamily will continue to be, 85-90% of what it is that I do. So.
Great. And do you work directly with any Canadian investors? How would a Canadian doctor, for example, get in touch with you, and what would be the process for that?
Well, yeah, I mean, they can. We have some Canadians for sure, and generally, anybody who joins up, if you go to our Wealth Formula group, it's wealthformula.com. You can always sign up for an investor club or something like that. Certainly not plugging anything, but that's basically how you do it. Yeah, I mean, you can. I think in the US, there are some challenges with things that are uniquely American. Obviously having an LLC in the US and that kind of thing. But yeah, we work with Canadians. I work with Israelis and people all over the world. There's always a way to invest if people are interested. So.
Great. Awesome.
Fantastic.
And talking about plugging away, I'm gonna show your book over here.
You guys have to grab a coffee.
Yeah, that's sort of a Wealth 1.0 book, where it's not too sophisticated, but I think it just really talks about basics. And I always talk about, Wealth 1.0, 2.0 and that kind of thing. But, I think of that book as, it's fine. It's not really, doesn't really cover the conceptual stuff that we talked about today, which I think are a little bit more sophisticated and probably really more valuable. But I think if you're brand new to the concept of cash flow and all that, maybe it'd be useful. But
great. Yeah.
Absolutely.
We've included the link to Amazon. I actually included Amazon.ca because that's where I bought Buck's book, but yeah, just get on there, order the book, write a
Absolutely.
review. I wrote my review. And
Always write a review.
we have a question. So we want to open up for questions, please.
Sure.
Write your questions in Q&A. So this is the chance for all our live webinar, the people to kind of ask the question from our experts we bring on. This is kind of what makes our kind of live webinars better than the YouTube. This is also going to be recorded and on YouTube as well. But yeah, we have a question here for you, Buck. Do you see the questions, or would you like?
I can read it out just so everybody knows.
Sure.
Okay, so it says, Robert has moved into assisted living, recently taking down $120 million loan for new development. Is Buck looking at this industry?
I'm not. And I think that the challenge with assisted living, again, it becomes one of those things where now, if Robert moved into assisted living, it's probably because he's found people who are really good at that. I guarantee you, Robert's not become an expert in Kiyosaki's not become an expert in assisted living. I think that there's obviously the demographics are for assisted living are favorable over the course of the next 10 to 20 years. But I'll tell you, I did look into assisted living, a few years ago, 3-4 years ago. And the challenge right now is that there is a little bit of a glut. Everybody's looking at the same thing. Nobody's looking at this as a brand new concept. And we know the demographic cliff is coming. So what's interesting is that, banks were not even interested, US banks, the major ones like Chase and stuff, were not even issuing loans to assisted living facilities because there was so many of them. And because of that, there was a fair number of failures. So I'm not saying it's a bad space to be in. I think you got to go in there you got to find the best in class, providers and operators and that kind of thing. And for me right now, I don't have the, for me, I'm not comfortable with that space right now. The other thing I will tell you is that my philosophy has always been boring, right? I like boring. And I shouldn't say always, because it wasn't always like this. And I've lost millions of dollars in my life because of this, because of chasing, shiny things. And I'm not saying assisted living is shiny, but what I'm saying is sometimes you find some things that work, right? And, but then you want to look for other stuff. And for me, that's always been sort of the enemy of the enemy is of great is better. And so to me, like, I have not really tried very hard to go outside of what I've been doing because it's worked so well. And if you look at it from a risk adjusted return type profile, I've just found nothing that competes with multifamily. So
nice.
Great. So we're in the right space, I guess.
We're in the right space.
We have another great question here for you, Buck.
Somebody says, thank you for sharing your experience and wisdom. And if you can provide one financial advice for a younger you when you just finished your surgery fellowship, what would the advice be?
You got married the day you left university, right? So maybe
I just got divorced, so that one won't work. Let's see. I would say, I think the, I think that, the earlier that you can start acquiring assets, the better. I do think that there's probably value in understanding yourself and what your own limitations are, and what not only limitations in terms of your ability, but your time and what it is that you want to do. One thing that I did that turned out being really good. In fact, the best thing I did when I left training was because, I had read Robert's books and I did have my own background experience, growing up in a real estate family, paid for college, paid for med school, and got me a nice upper middle class lifestyle growing up, and so I did trust it. And so what I did is when I started practice, I mean, I never invested in stocks, right? If the funny thing is, my family stocks are considered very dangerous, right? Like my mom will call me and she's like, "You're not investing in stocks, are you?" Um,
GameStop, you haven't.
well, obviously, but the thing is that it's sort of counter to what you would think conventional wisdom is. You've invested your 401ks or your stocks and all that stuff. But my family, that wasn't the case. It was like you're investing in real estate or you're doing something dangerous. So I had that mindset, and so what I did is I made it a goal that I would buy at least one apartment building a year after I finished training. And, they weren't, they're not the kinds of projects that we're doing now, $100 million projects. I was doing, I was buying like $1 million building and putting $200,000 is a down payment, that kind of thing. And I did that for, for a few years, and, at least one building a year I wanted to do. And what happened to me in my situation was that, like, and then this is a long story we don't need to get into, but I started a few medical businesses, and one it was a cosmetics business that was just crushing it in Chicago. And I tried to, basically go national, and with no funding, and ended up losing millions of dollars. And that I didn't have I didn't use any funding. I was funding the whole thing myself, and I opened 5 or 6 different offices across in different states, and at simultaneously, just a bad idea. And but at that point, everything I had touched had turned to gold. So I thought it was going to keep doing that, but it didn't, and I lost a bunch of money. And when it but one of the things that happened was that when I came through this, that was when all these buildings that I bought were up, like, in terms of the equity I put down, they were up like 400 or 500%. And again, I got lucky too. I'm not saying this had a lot of skill, but I was buying in the right place at the right time, and I was riding a wave. And but what I will tell you is that, you know, for somebody who's building a practice, building a business, one of the things that people do that's very dangerous is they keep putting that money back into their one source of income. And that becomes what I call single point failure, right? So you got to be really careful of that. And that's where the real estate became extremely valuable for me, because I'd lost so much money. But all of a sudden I had these buildings that were up, uh, from my investments, like, 500%. It totally saved me. Right. So avoid single point of failure, get into real assets. I think those would be the main things.
Great. We have another
Great advice.
question from Joshua. How do you source new real estate opportunities?
Well, it's pretty complicated. I mean, at this point, it's acquisitions team. You know, we have in our group now, we have a substantial portfolio, right? And it certainly helps to have, that kind of portfolio when you're going into a given market. So um it's different. And I think what your question is getting at is like, okay, when I was doing $1 million deal, or a $2 million deal, how did I source that? That's a good question. The first building I ever bought was a big loser. It was a big loser, but it was fortunately it didn't, it was like a it was like a $500,000 building, and I lost like $300,000 on it. I was maximally efficient at losing money on it. But there's the old saying about how you make money or lose money in real estate on the buy, and that's very true. What I had done initially was, I didn't take anybody's advice in this first building I bought, and just was, basically basing it on numbers. That's all I did. Numbers. I read Kenny McElroy, again, who's my friend. Now I read ABC's of real estate and advanced real estate and all this stuff. And I was like, yeah, it's easy. A bunch of numbers. I'm like a math guy. And so I just did the numbers and boy, this deal looks great. Well, I couldn't have been so more wrong about it. In real estate, it's, you know, especially on the smaller stuff like this, it's so easy to fudge numbers, and property management becomes such a big deal. There was a lot of nefarious activity in this acquisition from the seller's side, and I didn't know any of that. So lost money on it. The numbers were very good if they were real, but I didn't know how to look at a deal to make sure they were real. So that from that day onward, I never went out there and just looked at random deals and did them. I had the good fortune at this point of knowing some lenders, and I knew some, particularly one guy who kept feeding me these deals, and he would underwrite them, and he would know the seller, he would know me, and they were essentially off-market deals that kept happening for me. And it was a really good situation. And it wasn't because the numbers were hard to figure out, but the off market deals, especially when there was known quantities on the sell side and people who were bringing it to me were people I trusted, I could believe in the numbers. And that's an ongoing theme in this space, right? If it was just numbers, all of us doctors and engineers would be crushing it, right? Because we're good at numbers. But it's not. It's more than that. It's a lot more than that. It's about operations. It's about knowing the right people. And real estate is ultimately, like anything else, success in this space is about knowing the right people. So I would never, you know, now, of course, now when you're dealing with assets that are 50, $100 million assets, like we are, it's a different ball game because you can't fudge those numbers, right? You can't fudge them. It's now you're talking about small businesses. These are no longer $1 million, $2 million apartment buildings where you can, you know, the landlord can go and mess around with numbers and make it seem fake. You can't do that because every one of these assets is a great big asset. It's a small business essentially. This is no longer real estate. This is a small business. um and so those are a lot easier to go on market and bid because you know that, you know, and then you have an entire scalable, you know, due diligence team and all that. It's a completely different world. But for small time investors, I think the smartest thing you can do, honestly, if you're like looking at buying your own buildings and stuff, is create relationships with lenders and with brokers that run very deep, and to the point where they know that, you know, you are somebody who's going to be a repeat customer if you do them right, right? So I must have bought 5, 6 apartment buildings from the same uh, seller over and over again because of this one lender that we both knew. And a lot of this ends up being what sounds like luck, and there is some luck to it. But the thing is, you have to be looking for the luck. Right? A lot of times things happen around you that that are good luck, but they're not really good luck unless you're looking for them. And so this is kind of the name of the game. Um, Long story short, I think particularly when you're looking at small assets, it has to be based on a relationship. I would never buy something right now that was like, you know, 2-3 million bucks without knowing like somebody and it being off market and all this stuff. And that's relationships.
Great point. We're getting on to an hour here, so we'll try to make this as quick as possible. We got a couple of questions ourselves, but I think Buck has already answered that, so we can just go to the next one.
So, do you sell your real estate, and if so, how do you handle the big tax event?
Yeah. So this is this isn't okay. So the challenge on this is that I think probably the Canadian tax laws are very different than the US. Am I right on that or no?
Sorry, say that again. I was just
I think part of the challenge in this answering this question for me is that I'm assuming Canadian tax law is quite different from the
It
US.
is. It is in particular about the 1031 exchange, for example. That's a big tax benefit that is used in the US, which can't be used here in Canada. But there are certain benefits as far as Canadians looking to invest in the US and the treaty that exists, which allows them to be relieved from double taxation and what have you. But in general,
Okay.
real estate is a good investment for individuals to make. There are benefits, but not as business friendly or as beneficial as in the US.
And the good thing is
So-
the guy who asked the question is actually from the US.
Okay, so let me explain that one to you from the U.S. perspective, because it's this is something in my group that we call the golden hamster wheel, Jason. Right now, in particular, and we don't know how long this is going to last, but there's something. My group is very much focused on tax efficient investing. So let's say our group, let's say we acquire an asset. Depreciation is a huge thing in the U.S. and with U.S. tax law. What is depreciation? Again, I don't know if you have it in Canada, but basically there's this idea that if you acquire an asset that it inherently loses value over time, and therefore you can write off the value of that. Now, the funny thing with real estate, of course, is we know that generally real estate doesn't lose value; it actually gains value. So we have this tax advantage where we're showing losses over a period of time, even though we're not experiencing them. So in the case of multifamily real estate, if you did nothing else, you would have what's called straight line depreciation of 27 and a half years. Well, if you had an apartment building that was, $1 million or whatever, divide that by 27 and a half, and that's what you get in terms of your depreciation per year. Not bad, right? Okay, so let's add another layer to that. The other layer is that you can depreciate even though you didn't pay for the whole thing. In other words, you used leverage, right? It's $1 million building, but you only put in $200,000 of equity. Well, guess what? You're still depreciating the $1 million building. So, hey, even better, right? All right. Well, there's another layer of that. Another layer of that is something called a cost segregation analysis. So cost segregation analysis in the U.S. is where an engineering study is done, and it pulls apart what is determined as real property. Real property is basically, the asset itself. You can't pull stuff out of it. There's a determination between real property and personal property. What is personal property? Pretty much anything that you could pull out and throw out the window, even if you need to pull hard. Okay. So, as it turns out, in multifamily real estate, it's pretty consistent. I've done now probably 100 cost segregation analysis, and it turns out that approximately 30% of any given asset can be determined to be personal property, whereas 70% of it will end up being real property. Now, why is that important? Because real property, as we mentioned before, is straight line depreciation, 27 and a half years. Personal property, which it makes up 30%, as I said, typically in the US, you can depreciate that over 5 years. Now that's great, right? Because now you're accelerating depreciation. That's why you do a cost segregation analysis. You're taking 30% of that $1 million property, and now you're saying, I'm going to depreciate that over 5 years instead of 27 and a half. Fantastic. Now your K1's looking even more negative, right? Now, let's add one more layer to this. And that is the 2017 Trump tax law changes. So what Trump allowed us to do was to take that 30% that we were depreciating over 5 years and lump it all into the first year. Now think about that for a second. 30% depreciation of this property over in the first year. Well, what if it only required 20, 25% equity? So in theory, in this situation, you would have a tax deduction greater than the amount of equity you put into a deal. Crazy, right? So that works out really nicely. In theory, with value add real estate, you don't ever get 100%. Sometimes you do. We had one last year that was 106% for our investors. Most of the time, it's going to be somewhere between 70 and 90% because you raise a bunch of money for capital expenditures as well. Now, here's the thing, and this is where I brought you all to this, because when you sell that property, the IRS isn't dumb. They know you didn't lose money if you've got a huge refund coming or you have a huge profit coming. So now you have taken, you take all those depreciation dollars, you depreciated all that. And so now you have to pay recapture on that. In other words, hey, you deducted this, but obviously you didn't depreciate it. So you're getting money. So you have to pay recapture on that. So recapture is something you're going to have to pay. And in the US, in theory, it's like, okay, well, that kind of sucks. Well, now I have to pay it anyway. But no, here's the thing. You would have had to pay ordinary income taxes, which is, for our highest bracket is like 37% and federal taxes in the US. But if on recapture, you're only paying 20, I think it's 23%. So now you've saved a bunch of money on recapture, which is great. And then as long as you hold that property for a year, you're talking about, 20, what your long-term capital gains. And I think that comes out to about 23% or something. And in that situation, so now you still have a tax bill to pay, right? Yes, you do. But what if you took the money because you have listened to the wealth formula equation, and you're not going to take that money and just sit on it and, buy a Lamborghini, but you're going to invest it into something else immediately. Now, as long as the Trump law stays in place, which may just be for another year, you can essentially right now eliminate most of that tax burden that you have by investing everything that comes out back into the next deal. Because guess what? You've cycled that back in to another deal, and now you're getting all the depreciation there. Now, in our group, what ends up happening is in practice, people end up creating this wall of losses and depreciation. And every time there is a divestment, they end up with capital gains and recapture, but they don't end up having to pay it because they're basically taking this wall of losses that they have there and applying those losses. And so it's a little bit of a hamster wheel. And that's why, but it's a good hamster wheel. And that's why we call it the golden hamster wheel.
Great. Really appreciate that. We're getting to the end of the webinar here. Thanks to everybody for being so. I guess we'll close with asking
our two
you
questions that we like to ask our guests.
Yeah. And one being, what is your number one advice to passive investors? And by passive investors, we mean someone who wants to invest in real estate, but do it passively, not be actively involved. What would that advice, number one, advice be?
Well, I think you've got to know, like, and trust, your group. You got to have, you basically, it's about the people. It's not about the numbers. So you have to find the right jockey for you. That's the biggest thing. It's about people. It's a people thing.
Very good. Very good. And now what is the second question? What is your number one advice to active investors?
An active investor also means that groups or individual who's looking to become an active real estate investor. I think you mentioned a few kind of experiences you personally had. So there was great advice there, but broadly speaking, if we tell a starting out active investor or someone who is in the business, what would be your advice to an active investor?
Yeah, I mean, I would say with active investors, I think make sure that you're completely, you want to do this. you know, I mean, I think unless you do active investing well, I think the based on the kinds of returns you can get as a passive, yeah, could you do better than you can as a passive? Yes, in theory you can because you wouldn't have any split, but in reality, you're probably most active investors, unless they really get into this game, are not squeezing every penny out of every deal. And so their returns are probably not going to be any better than being passive, and could be worse. And certainly the risk element is significantly worse. $1 million building will require, $250,000 to acquire. You could take that 250,000 and spread it across, 4 or 5, deals or more, and have exposure to thousands of doors across several different markets. So in the hands of a very experienced operator. So I would just be sure that that's what you want to do. Now, listen, my dad is an active guy. He's made good money doing it. I finally got him investing in my stuff now, but it's because he's 82, so.
He's ready to
Yeah.
sit back a little bit more.
Kind of, yeah. And he's realizing the returns we're getting is good, if not better than his. And he's kind of like, okay, well then why am I doing this?
What am I doing here? Yeah.
Awesome. Great. This was wonderful. We
Yeah,
really
Buck.
appreciate it, Buck. We're glad that you feel
Thank you
better.
so much. Yeah.
Look forward to possibly having you on again at some point. We watch and follow you, and it was great.
Everybody
really appreciate it.
tune into Buck's podcast because he brings some pretty awesome people in there too.
And great advice.
And
Great advice that he always
to
has it
learn.
all
Wonderful.
across.
Yeah, great. Thanks for having me, guys.
Thanks, everyone.
Thank you.
Okay, thank you.
See you,
Have a
everybody.
great
Have
day.
Take care.
a wonderful day.
Bye-bye.
Thanks.
Okay, bye-bye.